Welcome to all of you to this ITFA FinTech Committee webinar on the use of hybrid blockchain in trade finance. It's my pleasure to welcome you today. You're joining from almost all of the continents today, so very enjoyable for us on the panel to witness that. Welcome to all of you, whether it's your evening, morning, or your midday, as it is for us on the panel team. This is an educational webinar, as we like to do within ITFA, certainly on the FinTech side, to introduce you to the use of a hybrid blockchain and particular use cases in trade finance. So we're going to look not only at, of course, at what hybrid blockchain is about, but also how trade finance can take advantage of this piece of technology and its hybrid nature around various use cases. And as we have discovered over the years within trade finance technology, the regulatory perspective is critical. So we're going to look also at what is expected from regulators in this area. As you know, my name is Andre Kasteman. I'm heading the FinTech activities within ITFA, and I'd like to highlight our gold website sponsor, London Forfeiting. Just a bit of advert to our website sponsors, including also the silver sponsors, Sullivan and Willis Towers. Nothing to do with this webinar in particular, but definitely an opportunity for those of you to become sponsors of ITFA's website. With this, I'd like to introduce our three panelists today. Göran Almgren of Enigio, Atul Kekade of XINFIN, and Peter Ken of CargoX. I have selected those three companies because indeed they're using blockchain in a way that is hybrid and across multiple use cases. So even more interesting to look at the breadth of opportunities for us on the trade finance side to take advantage of that technology. We're going to structure this webinar in the following parts. First, a look at a short introduction, then a deep dive into the different use cases, then some insights on what is required to grow adoption and how adoption will take place, and some call to action to finalize the session. As usual, feel free to use the Q&A box in order to submit your comments, questions potentially, and we will be happy to handle them on the fly. Just a bit of introduction from my side, because it took me some time to be attracted and convinced by this new technology, because I'm coming from the very traditional world of everything gets centralized, SWIFT, Euroclear, hub platforms, cloud platforms, everything is centralized. And blockchain suggests another way to organize data sharing. And so I must admit, it took me years to be attracted by the technology. But when I started to discover some of our FinTech members like Enigio, XINFIN, about 2 years ago or 18 months ago, I started to see the light potentially in terms of how to add value into the very traditional world of payments, wholesale banking, trade finance. And what is most interesting these days is not what I think, but what the regulators think about it and how serious the regulators are around the use of blockchain across different use cases. And here, for instance, I copy some very recent news about the use of cryptocurrency, which is based on blockchain, and the future of payments from the OCC. Brian Brooks, who is an ex-employee of Coinbase, a cryptocurrency exchange, is now acting comptroller of the currency for the OCC. Very interesting work there, and we'll see with the new administration how this will evolve. But definitely the regulators, whether it's here on the US side with the OCC, or in Germany in capital markets with electronic securities, and Germany here in particular, also developments reported by the press, also very engaged to legalize the use of blockchain and the use of digital assets. So we all know that technologies are very advanced, and particularly in trade finance, but we also know that the regulators have a key role to play to unlock value from all of those new technologies, new ways of working, whether it's on blockchain or not. So that's why I want to highlight what is happening, just with a few examples on the regulatory side, because that is going to be very important for us going forward. And it's my way to assess whether this technology has a chance to emerge and offer value in trade finance as regulators make it happen from a legal perspective, whilst technology players as Atul, Goran, and Peter make it happen on the technical side. With this, I'd like Atul to start to tell us his views about hybrid blockchain from the XINFIN perspective.
Hi everyone, this is Atul Kekre. We are ITFA members through XINFIN. XINFIN stands for Exchange Infinite, and it's almost a 4-year-old project now. And we've been, since the initial days, we've had exposure to Bitcoin and Ethereum, and it was just amazing. It kind of felt the way it was going to change the world back then. But coming from a very mainstream background, right? So I worked very closely on the core banking systems, whether it was Citibank, HSBC, or some of the other banks. Something didn't feel right at that time. And when we tried to approach the mainstream banks and financial institutions and enterprises on, look, this is how the technology is shaping up, this is how it's getting adoption, and this is how it works as a purely public network where you can verify everything. Everything is just everything can be public, can be known. You can know where the funds are going from this place to another. And when we took this architecture to enterprises, the first thing we heard is that this does not make sense. You guys are stupid. This is not something that we will adopt in any way. And it really started from there. Literally, getting the door shut on your face in the meeting. But as we started to show our resilience and kept working with the enterprises and banks and financial institutions, we kind of there was a notion about hybrid blockchains that was developing, because people knew enough that you need to have a decentralized trust, a network which can verify transactions, which can connect multiple entities together without any centralized control. But at the same time, as an enterprise or financial institution, you want to keep, you cannot let go of your privacy or your sensitive information, because there's so much of regulations around data protection, and you're essentially working with your customers' data. So this is where we kind of devised, we architected a blueprint for what eventually, when enterprises start working with something like this, would look like. And this 3D mesh was actually developed in-house, in which you can see that the public network can be used for for the transparency and the trust that companies or even individuals can connect to. But you can still have a sort of interoperability or a bridge with the way your heavy legacy infrastructure is working, which is giving you all the security, speed, and data sensitivity. You're protecting it there, but you can still make it work in the way that the technology can actually create or solve a lot of use cases out there. Moving on to the next slide. So how does it work, right? What are we really trying to achieve here? So one of the first things that people notice on the public blockchains is that everything is public. So you can verify a transaction. You can see that, okay, the money has gone from one address to another, and with decent amount of analysis on these transactions, you can pretty much know everything. And that can be a good thing, and that can be a bad thing as well. So in a good way, this is what brings trust together, that you can actually verify a transaction publicly, and the network runs 24/7 without any central authority. It runs across borders, and it has its own the scalability, the network effect that it brings together. But when two enterprises are trying to work together on that network, what you're essentially doing is you're generating an offline hash of your transaction or your sensitive data and putting it on the public network, so that, let's say, if this is a payment confirmation, or if this is a letter of credit that has passed from point A to point B, you can verify that, okay, it has been transacted, it has been confirmed, and the payment has actually been triggered. But other participants of the public network cannot make any sense out of it, because for them it's just a hash value that they cannot decode. And this brings a very powerful feature. And some of the participants on the webinar today are these are the companies that would eventually be working on a structure like this that would make the whole blockchain very as a infrastructure as more legacy institutions and banks start to work with it. So in trade finance, these four are pretty much the pillars of trade finance, as you say, right? So one is information on the transaction, one is risk mitigation, one is the finance, and the most important part is the payment, right? So when you actually put a trade finance use case on blockchain, how does it really work? So let's look at some of these, some of the trade instruments. For example, it could be an invoice or a receivable, a letter of credit, a bond or a guarantee, or documentary collections. Now, when they are originating from an offline world, right? When they're in our case, when we say offline, it's actually something that's not on the blockchain yet. So it's coming from a legacy institution, and it stays there. It stays as a private network. It kind of stays there. You don't really bring that on top of the blockchain itself. But what you bring here is you can link the payment commitment or the payment obligations that are linked to these instruments on the blockchain, because in terms of the platform that we have, it provides a very robust smart contract capabilities. So you are able to design a workflow that will automatically trigger a payment when a certain action has kind of occurred. And that's how you can bring payment, connect the payment obligations connected to those sensitive information on the network, on the public network, while the sensitive information is still there on the private network. One of the biggest things that is what essentially a network has to do is mitigate the risk for a transaction. So, for example, right now, trade finance so far has been pretty much run by banking institutions, but now there is an interest from banks, or even overall there's a regulatory push to make this network more accessible to the alternative investors as well, just because the liquidity demands are so high that if the alternative investors come and participate in the network, it would just create more liquidity in the network itself. So in that case, how do you really mitigate the risk, right? Blockchain, the public blockchain, it does have its own digital asset token. So in XINFIN's case, it is the XDC, and you can collateralize the risk. So you can collateralize the payment obligation that's coming from your offline or your private network, and kind of keep it as a risk mitigation mechanism on the network itself. And it works amazingly well, because you are essentially working on a community-driven digital asset infrastructure. So it's the community that's adding liquidity to it. And instead of going to an offline kind of risk mitigation process where you still don't know whether this payment obligation would be honored or not, you will still be able to liquidate your collateral in the open liquidity market, which gives it a very powerful feature. So this is one of the first legs where you can combine the private layer with the public layer. Second is how do we drive more liquidity to the market? So there are hundreds and potentially thousands of fintech originators now out there, and we keep hearing from them that their liquidity requirements are, they're so high that the current liquidity that is provided to them from banks or whatever is accessible is not enough. So the moment you bring that risk mitigation and payment obligation on the public network, which is really connecting or bridged from the all your sensitive information which is in the private network, you are able to also collateralize it, or obviously you collateralize it at the risk mitigation layer, but you are able to generate lending for that instrument directly from alternative asset investors, and it becomes a completely different layer of trust, far more scalable, far more open to participation from the network point of view, from the global point of view, where fintechs can actually get, or even banks. Right now the distribution happens in the bank-to-bank world, but there's a growing interest in the banking world itself to distribute that in the tokenized form to the alternative asset investors. And that's where you are able to connect the private public part for generating more capital through lending. An important part here is payments itself. Now, the good thing is blockchain has its own settlement mechanism, but you not need to use it, right? Because you can pretty much use a traditional banking channel, and you can just use a payment confirmation coming from that on the public blockchain layer itself. So let's say you have a SWIFT payment confirmation, or you have a interbank payment confirmation, you can just use it as a transaction has on the payment itself. So that just gives you a complete flexibility of working or getting your trade finance related payments on the network. CBDCs are widely discussed. Everyone's talking about it, and sooner or later, we'll be seeing a large volume of settlement transactions working through CBDCs themselves, which will be directly done by central banks. That's one of the things that the blockchain really provides. So even if let's say there's a CBDC, you can connect that liquidity or interoperate with it using the public network itself. Now, the payment mechanisms are, they provide their own degree of risk mitigation. So, the participants can actually choose whichever they want to use. So if you want to go with traditional banking channels, you can use that. The network provides you, being hybrid provides you that feasibility. When CBDCs come up, you can use that. Right now, there is a strong growth of tokenized stablecoins. So the way it works is you are able to, get tokenized in actual cash, which is still lying there on the trust or, with the fund. You're able to tokenize it on a fully electronic token form that itself can be used for payments and settlement. And the last one, which is kind of new to this world and is beginning to kick off, is that you can have your native asset of the network, or you can have the digital asset of the network act as a collateral for creating something called a synthetic stablecoin. So what you're essentially doing is you're taking a price feed for, say, US dollar or euro or any of the fiat currencies that you really want to settle in, but the smart contracts make sure that, let's say there's even a volatile underlying digital asset, you can create a smart contract to peg that to the price feed. So it will adjust the value of its collateral. And while this is a medium that may or may not be used so heavily, it provides a more robust way of risk mitigation and far more, because it's community driven, right? The liquidity is coming from community. So basically, these are the 4 pillars of trade finance, which you can perfectly kind of incorporate as on the use case for on the blockchain platform with the hybrid kind of nature. And this is where you can start connecting your legacy finance to the blockchain itself. And this is what makes all the difference.
Okay, so very interesting to see that what we mean by hybrid is that what needs to remain private is indeed kept private, but potentially on a private blockchain or in any other form that the financial institutions need to secure. And through tokenization, the public information actually doesn't mean anything to the one who gets it, because you need the keys to decipher it, to decrypt it. But the public layer means that you have a shared ledger for anyone to use in order to check the status of those tokens. I suggest we now move on with Göran to some of the use cases. Göran, Peter, and yourself, Atul, because you already have covered quite a number of use cases, but we're going to dig deeper into some of those, and taking into account that we are here talking to financial institutions, and that data privacy is, of course, not only one priority, but potentially the top priority here. So moving on, going back to Atul for a particular use case on how the XDC hybrid blockchain is used.
Thanks, Andre. Thanks, Göran, for that wonderful slides. So, in our case, what we're really doing is, we are looking to connect the alternative investors out there in the market, and there's a huge growth of the private credit and alternative asset investors who would now ideally want to participate in the trade instruments related to the corporate or SME finance, which otherwise was only restricted to the banking world. And the reason why this market has opened up is obviously there's more private credit, but the fact that there's more origination that's coming from the fintech originators. So here in the diagram, what you're really seeing is all the origination that's coming from the working capital platforms from SME and corporate is something that we are bridging. So this is where we are able to record the payment obligation that's coming from the buyers themselves or the suppliers themselves, and or whoever has the payment obligation. It could be deep tier suppliers as well, and able to collateralize it with the digital asset. So making it ready for something widely known terms known as a decentralized finance in the blockchain and crypto world. So as long as you have a payment obligation and you have a blockchain representation of a token, and you have collateralized it with, in our case, XDC as a network or as a digital asset was in fact created because it was very clear to us that some of the other public blockchain networks would not be able to specifically cater to this use case, which has its own size itself, right? So trade finance is in trillions, and for the participants to specifically trust that digital asset collateral, or to have the trust overall in that origination system and liquidation system or price discovery mechanisms for coming in from those origination, you need to have something which is more specific to that use case. And what essentially we do is so we have a robust public network, and in the coming slides maybe we can show you the actual so what this slide basically shows, and this is not how an actual instrument is linked. The UI is only given for demonstration purposes. So only a certain kind of certain metadata on the instrument is captured out there, and it's converted here, connected to the payment obligations. And you can actually go to the next screen. So that sensitive information is hashed. The hash is put on the contract itself. It's linked to a payment obligation, which kind of sits between the working capital platforms or origination platforms, and then it's converted or it's deployed. In the next slide, you can see that it's actually deployed, and it acts as it is represented on the token verifiable on the in the token form on the public network itself. Now, what we do basically is we provide a decentralized finance contract or a smart contract to this origination, which is coming in the form of invoices or receivables or other trade instruments out there, so that all the alternative asset investors, which may be family offices or funds or even accredited investors in certain jurisdictions, they have rules for accredited investors with, say, minimum ticket size of $100,000, or it could be a pooled capital coming in from different funds. So we are able to connect this origination that's coming as a requirement that's coming from the working capital platforms or fintech originators, or some of the banks have shown interest in this as well, to these alternative asset investors, the pool which is kind of developing very rapidly out there. And we've been able to scale up this network because it's in a way peer-to-peer form. So while we do give a protocol, so we are makers of the protocol for the originator or working capital platforms on the other one side to connect this, and the funds to connect the liquidity to the network or to this origination. The network totally acts in a decentralized way. So we don't really control. What we've done is we've been able to provide a tokenization infrastructure for instrument to come in, to be able to collateralize the risk with a community-driven digital asset, which is XDC in this case, and being able to connect this origination to provide them liquidity coming from alternative asset investors.
So here too, we see an image of the public version, the public DLT, which is showing hashes. And of course, the person accessing this data has no clue about the content of the transactions, because if you don't have the private keys. So similar concept as what Gervin explained in terms of using the public DLT to avoid people to be a member of any private system. They can access this information, but the information cannot be used unless they get the keys from their counterparties. Okay, thank you very much, Atul. Of course, adoption is key. So we'll look at what is needed to grow adoption, both on the integration side as well as on the regulatory side. I insist often on the regulatory side because that's where a lot of obstacles can be found on the road to adoption. So Atul, on your side, how do you see adoption taking place?
Yeah, so in terms of blockchain as a network, right, a public network, we've been live now, and it will be almost 2 years since we were live, and we are really a second generation blockchain out there. There is a good number of participation. There are almost 132 master nodes who are running this network. The transaction fees are sorry, we are like third generation. I was kind of covered up on the screen, but there are almost close to 20,000 community members who are transacting. The transactions are happening, and they are happening at a fraction of a cost. The transaction finality kind of is very interoperable with what the legacy world kind of processes. So we have a 2-second transaction finality on the XDC network. The speed throughput has been tested at 2000 TPS, but we've been able to stretch it to 20,000 or 30,000 depending on some of the configuration changes. And to even highlight what we've been able to put this on the table here, I think, is it in the next slide? Yeah, so we've been able to get an actual transaction here, right? So this is an actual transaction where you can see the value. I think this is related to an invoice, and you can see here the value is 200,000 XDC, which is close to 1254 US dollars, and this is probably an actual invoice. So you cannot verify anything from the transaction itself. You just know that this transaction has happened. The transaction fee is incredibly low. So this is what we've really worked on. There was a talk on first or second generation blockchains where the fees and processing times are high, but you can see that the transactions fee is billionth of a dollar, literally, which shows that the network that we have live has immense scalability. And on top of that, we have some of the initial fintech originators that have already started to connect to the network and draw liquidity. So Validus is one where we already started transaction. funding societies is being integrated. And both these originators are regulated entities in Singapore, where we are able to connect the liquidity coming in from alternative asset investors, record the payment obligations, collateralize that risk with XDC backed synthetic stablecoin, and provide them or connect them with that liquidity. If you're able to open the page above just for a second, if it is possible, the TradeFinX markets, it shows that the market, the link on top is, can you open that by any chance, or it's okay if it's not open? So in terms of the actual adoption, it's already happening and it is verifiable. If anyone is able to click the link on top about TradeFinX markets, you can see that the originators are already being added, and we have independent funds, family offices who are running our nodes, contributing to the network's liquidity, and they are basically providing something called staking, which goes directly into the payment obligations that are committed by the fintech originators themselves. So in terms of adoption, we're already there. We're live. We've been live for a while now, and even the actual use case transactions are beginning to happen. If you look at the overall size of trade finance, I think what, 20 trillion, 30 trillion, I don't even know the figures. Whatever I try to research, I get different numbers all the time. But all we really have to do is, the network is open for more originators to connect. So it could be banks as originators, it could be fintechs as originators, it could be working capital platforms, it could be the corporates themselves. Now we are at a stage where they just have to connect, add their payment obligations. We have opened up the network to third-party credit insurers who can come in and collateralize that origination with a digital asset, which has a fair amount of liquidity now, but it has obviously been growing. And on the other side, all the wide class of alternative asset investors who can just connect and scale up the network by themselves. So we are just kind of monitoring the protocol at this time, while most of the endpoints are there for all these participating entities to connect.
Thank you, Atul. Atul, on your side, what is the call to action you want the banks or regulators or ITFA to hear?
Well, we've been very proactive in dealing with the market. So first of all, in terms of the last slide where you've written ADGM there, we already, through TradeFinX, we already ADGM Reg Lab participant. And one of the good things, it gave us a confidence. Having forward-looking regulators, someone who support innovation, kind of helps us evolve our business case, and that's the reason why we've come to this point where live transactions are kind of happening. And if you saw some of the live transactions and hashes and slides related to TradeFinX markets and XINFIN as a network, the good thing is today fintechs and banks can, using API endpoints, they can really connect their payment obligations through smart contracts. They are able to fully tokenize that origination. Whether credit insurers as institutions or even funds who want to act as credit insurance can just collateralize that risk, of course. And alternative funds can just run more nodes. They can add more liquidity in whatever liquidity form that they have. So there are a fair amount of regulated digital asset exchanges. I understand while banks are even starting to get into this field right now, because DBS just recently announced their crypto exchange in Singapore, and there are other banks like Standard Chartered who know now that, okay, this liquidity is something, very serious numbers, and that's why they've already started to connect specialized custody solutions and exchange to that. But the thing is, while all those institutions can come, I think these private lenders, alternative funds have a large part to play in providing the liquidity to the network itself. And that's why they can just generate yields in a totally peer-to-peer format. Again, just to reconfirm the point that we are makers of the protocol, we are makers of the specifications of the network. But at this time, almost 95% of the network is run independently by third-party members community, which keeps the network functioning. And as we see that more trade finance specific players enter in the market in terms of alternative funds, they'll also be able to add their decentralized liquidity to it. And that's what makes it a whole network effect game, and can just scale up from there. And eventually, the mainstream institutions will have enough to see as a use case in terms of live transactions, and just know that, look, this works. This is not just pure speculation or something. This thing actually works. It helps half of the world's population. What I'm referring to is all the MSMEs that employ half of the world's population, and eventually all the liquidity that gets in the market goes to them, right? So this is really a call to action from our side to the participants.
Thank you, Atul. I see one question in the chat, and I would expect it for you. The question is, if a tokenized asset goes unpaid, who will act for the collection from the defaulted adapter? Would it be the originator servicing the asset?
Yes, that's a good question. Ideally, the originators that we add are regulated. So, there is a very strong guarantee on what is the origination coming in from that case. So, for example, Validus is MS regulated, and they only work with companies or buyers that are directly backed by the government itself. So that payment obligation is coming from the government itself for not just the government, but the deep tire kind of company. So that is kind of a guarantee that it will go through. But one of the strong mechanisms that we understand that this will not be enough, and that's why XDC is for. Eventually, XDC is an asset which is you can use to mitigate your risk. So while XDC may be volatile, there's all these amazing smart contracts that can be put together to create synthetic stable assets, which can just collateralize the risk for eventual lender.
Thank you. I see no further question. We're coming to the end of this session, so I'd like to thank Goran, Atul, and Peter for sharing their insights and definitely commercial use cases in terms of using hybrid blockchain in trade finance. We will surely get back for more deep dives into those commercial offerings. As we see the market really going this way as well. This does not, of course, remove the need for integration with existing technologies. Indeed, interoperability can mean different things depending on the pieces of the puzzle we want to assemble. So, and definitely also on the regulatory side, we continue to work with various regulators and with the banks who are talking to those regulators to recognize those virtual assets and the new technology capabilities into the laws when applicable, certainly for negotiable instruments. And today we released the ITFA newsletter of January, where we have provided an update, a status update, a wrap-up report on our regulatory advocacy activities. You can find it in your inbox or tell us if you didn't receive the newsletter. Will add you to the distribution list. So thank you again, Goran, Atul, Peter, and thank you to all of you for joining us today. And we're looking forward to talking to you very soon on yet another episode of the FinTech webinars. Have a good day.